Here's a paradox that costs investors hundreds of thousands of dollars. They'll spend hours researching which fund has the lowest expense ratio, debating whether to pay 0.03% versus 0.05%, trying to save a few basis points on fees. And they should, costs matter enormously. But then they'll completely ignore tax efficiency, which typically costs them 150 to 250 basis points annually. That's 50 to 80 times more than the expense ratio they're obsessing over. They'll move their portfolio from one brokerage to another to save $5 per trade. But they'll hold all their bonds in a taxable account and all their stocks in an IRA, costing them thousands per year in unnecessary taxes. They'll rebalance whenever they feel like it, triggering capital gains without thinking twice. They'll sell winners to buy more of what's down, creating taxable events that could have been avoided. And after 20 or 30 years of this tax-inefficient behavior, they wonder why their actual wealth doesn't match what the retirement calculators predicted. The answer is taxes. The overlooked, underestimated, devastating impact of taxes on long-term wealth accumulation. Before we dive deeper into this critical topic, I want to ask you to help us reach more investors who need to hear this message. Please take a moment to like this video and subscribe to the channel. Enable notifications so you don't miss future content about building wealth intelligently. The strategies we're going to discuss today could literally add hundreds of thousands of dollars to your retirement nest egg, and I want to make sure as many people as possible benefit from this knowledge. You know, I've been in this business for almost 50 years now. I started on Wall Street in 1976, fresh out of UCLA, wearing that ridiculous brown suit I've mentioned before, thinking I understood finance because I had an MBA. And I did understand some things. I understood portfolio theory, risk-adjusted returns, diversification, the efficient market hypothesis. But you know what they didn't really teach us in business school? The practical, devastating impact of taxes on real-world investment returns. I learned that the hard way. Not through catastrophic losses, but through something more insidious. Watching portfolios that should have grown to substantial wealth somehow underperform expectations year after year, decade after decade. And when you dig into the details, when you really analyze what happened, the answer is almost always the same. Taxes. The silent wealth destroyer that most investors barely think about until it's too late. Today, I run BlackRock, the largest asset management firm in the world. We manage over $11 trillion. And let me tell you something that might surprise you. When we sit down with sophisticated institutional clients, pension funds managing tens of billions of dollars, sovereign wealth funds managing hundreds of billions, do you know what they obsess over? Tax efficiency. These are some of the smartest investment professionals in the world, and they understand that after-tax returns are all that matters. Not gross returns. Not performance relative to a benchmark. After-tax returns. Because that's what you actually get to keep. That's what compounds over time. That's what determines whether you retire comfortably or struggle financially. But when I look at how most individual investors approach their portfolios, I see something completely different. I see people who've internalized the importance of low fees, which is great. We at BlackRock have been champions of low-cost investing for decades. But they've completely missed the lesson about tax efficiency. And the result is they're winning the battle over expense ratios while losing the war over taxes. Let me give you some numbers to illustrate what I'm talking about. Imagine you have $100,000 invested in a diversified portfolio. Your funds charge 0.05% in expenses, which is excellent. But you're not being tax efficient. You're triggering unnecessary capital gains. You're holding tax-inefficient assets in taxable accounts. You're harvesting losses poorly or not at all. You're rebalancing without considering tax implications. The total tax drag on your portfolio might be 200 basis points, 2% annually. Now compare that to an investor who pays 0.20% in expenses, not as good, but makes up for it through superior tax efficiency. Maybe they're only losing 50 basis points to taxes annually because they're strategic about asset location, they harvest losses effectively, they're mindful about when and how they rebalance, they understand which accounts to tap first in retirement. Over 30 years, assuming both portfolios earn the same gross return of 8% annually before costs and taxes, the first investor, the one obsessing over that 0.05% expense ratio while ignoring taxes, ends up with about $660,000. The second investor, who paid more in fees but less in taxes, ends up with about $830,000. That's $170,000 more wealth, from the same starting point, from the same gross returns. The only difference is tax efficiency. Let me say that again because I want this to sink in. $170,000 difference. Because one investor understood taxes and the other didn't. And that's a conservative estimate. In many cases, the gap is even larger. Now, I know what some of you are thinking. Larry, I'm not a high earner. I'm in a low tax bracket. This doesn't really apply to me. And I understand why you'd think that. But you're wrong. Tax efficiency matters at every income level. In fact, it often matters more for people with moderate incomes because you can't afford to waste money on unnecessary taxes. Every dollar you give to the IRS unnecessarily is a dollar that's not compounding for your retirement, your children's education, your financial security. Or maybe you're thinking, but I'm investing in tax-advantaged accounts. I have a 401k and an IRA. Aren't I already being tax efficient? And yes, using tax-advantaged accounts is important. It's foundational, but it's not sufficient. Because tax efficiency isn't just about which accounts you use. It's about what you hold in those accounts. It's about how you rebalance. It's about when you realize gains or losses. It's about the order in which you withdraw funds in retirement. It's about dozens of decisions that most people make reflexively without understanding the tax consequences. I want you to understand something fundamental. The tax code in the United States, and in most developed countries, is not neutral with respect to investment returns. It treats different types of income differently. It treats different holding periods differently. It treats different accounts differently. And if you understand those differences, if you structure your portfolio and your investment decisions around those rules, you can legally and ethically reduce your tax burden by tens or hundreds of thousands of dollars over your investing lifetime. This isn't about sketchy tax shelters or aggressive strategies that might get challenged by the IRS. This is about basic, straightforward tax-smart investing that every investor should be doing but most aren't. And the reason they're not is simple. Nobody taught them. Financial education in this country focuses on the sexy stuff, picking stocks, timing markets, finding the next hot investment. But the unglamorous, technical, incredibly important topic of tax efficiency? That gets ignored. At BlackRock, we've done extensive research on this. We've analyzed thousands of investor portfolios. We've modeled different tax strategies over multi-decade periods. We've looked at the behavioral patterns that lead to tax inefficiency. And what we've found is both disturbing and encouraging. The disturbing part: the vast majority of investors are dramatically underperforming what they could achieve simply because of poor tax management. They're leaving enormous amounts of wealth on the table through behaviors that could easily be changed if they just understood the implications. The encouraging part: tax efficiency isn't complicated once you understand the principles. You don't need to be a CPA. You don't need sophisticated software. You don't need to spend hours managing your portfolio. You just need to understand a handful of key concepts and build them into your investment process. And the impact on your long-term wealth can be transformational. I'll give you an example from my own experience. Early in my career, before BlackRock, I was managing portfolios and I was focused on gross returns. I wanted to beat the market. I wanted my clients to see strong performance. And I was achieving that. My portfolios were performing well relative to benchmarks. But then I started really looking at the after-tax returns. And I realized that all this trading activity, all these tactical moves I was making to try to add a few percentage points of excess return, they were generating massive tax bills. And after taxes, my clients weren't actually much better off than if they just held a simple, low-turnover portfolio. That was a humbling realization. Here I was, a professional with sophisticated analytical tools and years of training, and I was costing my clients money through tax inefficiency. That's when I started getting serious about understanding taxes. About building tax efficiency into every investment decision. About helping clients think holistically about after-tax returns rather than just focusing on pre-tax performance. And that lesson has stayed with me through my entire career. When we built BlackRock, when we developed our investment philosophy and our client service approach, tax efficiency was always central. Not as an afterthought, but as a core principle. Because we understood that our fiduciary duty wasn't just to generate returns, it was to maximize the wealth that our clients actually get to keep after taxes. Now, I want to be clear about what I'm not saying. I'm not saying you should make investment decisions purely for tax reasons. I'm not saying you should hold on to losing investments just to avoid realizing a loss. I'm not saying you should let the tax tail wag the investment dog. Investment decisions should still be driven by sound financial logic, by your asset allocation targets, by risk management, by rebalancing needs. What I am saying is that when you're making those investment decisions, you need to be thinking about the tax consequences. When you have a choice between two approaches that are roughly equivalent from an investment perspective, you should choose the more tax-efficient option. When you're deciding which assets to hold in which accounts, taxes should be a primary consideration. When you're rebalancing, you should be strategic about how you do it to minimize tax impact. This is what I mean by tax-aware investing. You're not letting taxes drive everything. But you're also not ignoring them. You're incorporating tax considerations into your decision-making process in a thoughtful, systematic way. Let me tell you why this matters so much right now, in this particular moment. We're in an environment where returns are likely to be more modest going forward than they've been over the past decade. The easy gains from falling interest rates are gone. Valuations are elevated in many asset classes. Future returns might be in the 5% to 7% range rather than the 10% to 12% many investors experienced recently. And in that environment, every percentage point of return you can preserve through tax efficiency matters even more. If you're earning 10% gross returns and losing 2% to taxes, you still end up with 8% after tax, which is pretty good. But if you're earning 6% gross returns and losing 2% to taxes, now you're down to 4% after tax. And over 30 years, the difference between 8% and 4% compound returns is staggering. It's the difference between wealth and just getting by. So this isn't academic. This isn't theoretical. This is practical, actionable knowledge that can have an enormous impact on your financial future. And most investors are completely unaware of how much money they're losing. I remember a conversation I had with a very successful entrepreneur. Brilliant guy. Built a company from nothing to hundreds of millions in revenue. Sold it. Had substantial wealth to invest for retirement. And he told me he was managing his own portfolio. Which is fine. Some people have the knowledge and discipline to do that effectively. So I asked him about his approach. And he described a very reasonable asset allocation. Low-cost index funds. Regular rebalancing. All the things you'd expect from someone who's done their homework. Then I asked him about tax efficiency. About asset location. About tax loss harvesting. About how he was managing his withdrawals to minimize tax impact. And he looked at me like I was speaking a foreign language. He had no idea what I was talking about. This was someone who'd built a successful business, who understood complex financial concepts, who was sophisticated about investing in general. But he'd completely missed the tax efficiency piece. So we ran some numbers. We modeled what his portfolio would likely be worth in 20 years with his current approach versus a tax-optimized approach. Same asset allocation. Same funds, just different account placement, systematic tax loss harvesting, and strategic withdrawal planning. The difference was over $400,000. On a $3 million portfolio, proper tax management was worth $400,000 over 20 years. He was stunned, and then he was angry. Angry that nobody had explained this to him before. Angry that he'd been leaving so much money on the table. Angry that the financial services industry talks constantly about fund performance and expense ratios but rarely emphasizes the tax efficiency piece with anything like the same urgency. And he's not alone. I have that conversation all the time. With clients, with friends, with family members, smart, successful, financially literate people who've somehow missed this crucial aspect of wealth building. And every time, once they understand the numbers, once they see how much difference it makes, they're shocked. That's why I'm talking about this today. Because I want you to have that same realization, but earlier in your investing journey. Before you've spent decades being tax inefficient. Before you've given the IRS tens or hundreds of thousands of dollars more than you needed to. While there's still time to implement these strategies and capture the full benefit over the rest of your investing lifetime. Over the next sections, I'm going to walk you through the key principles of tax-efficient investing. I'm going to explain asset location, how to think about which investments go in which accounts. I'm going to discuss tax loss harvesting and why it's one of the most powerful tools in your wealth-building arsenal. I'm going to talk about withdrawal strategies in retirement and how the order in which you tap different accounts can save you tens of thousands of dollars in taxes. I'm going to discuss the specific behaviors that destroy tax efficiency and how to avoid them. This isn't going to be a comprehensive tax guide. I'm not a tax attorney, and you should consult with qualified professionals about your specific situation. What I'm going to give you is a framework for thinking about taxes as an integral part of your investment process. The mental models, the key principles, the common mistakes, the strategic opportunities. Because here's what I've learned in 5 decades of doing this. Successful investing isn't about one thing. It's not just about asset allocation. It's not just about low costs. It's not just about discipline. It's about getting all the pieces right. And taxes are one of those pieces. A big piece. Maybe the biggest piece that most investors completely neglect. At BlackRock, when we manage money for our clients, we don't just think about gross returns. We think about after-tax returns. We don't just try to minimize expense ratios. We try to minimize total drag, expenses plus taxes. We don't just focus on market risk. We focus on after-tax wealth accumulation. That's what fiduciary responsibility means. That's what putting clients first actually looks like. And you should approach your own portfolio the same way. Not just as a collection of investments trying to beat a benchmark, but as a tax-optimized wealth-building machine designed to maximize the dollars you actually get to keep and spend and pass on to your heirs. That's the difference between investors who build substantial wealth and investors who wonder where all their money went. It's not intelligence. It's not luck. It's not even investment performance. It's attention to detail. It's systematic implementation of proven strategies. It's refusing to give the government $1 more than you legally owe. So let's begin. Let's talk about how taxes really impact your wealth. Let's discuss the strategies that can save you tens or hundreds of thousands of dollars. Let's build your understanding of tax-efficient investing from the ground up. Because this knowledge, this framework, this approach to thinking about your portfolio through a tax lens, it could be worth more to your retirement security than any other single piece of investment advice you ever receive. And unlike picking the next hot stock or timing the market perfectly, which are extremely difficult if not impossible, tax efficiency is completely within your control. You can implement these strategies today. You can start capturing the benefits immediately. And over time, those benefits compound into truly life-changing amounts of wealth preservation. The tax code is the rules of the game. Most investors don't bother learning them. They just play and wonder why they keep losing. I want you to learn the rules. I want you to play strategically. I want you to keep every dollar you're legally entitled to keep. Because that's your money. You earned it. You saved it. You invested it. And you deserve to keep as much of it as possible within the bounds of the law. Let's make sure that happens. All right. Let's get into the mechanics of tax efficiency and talk about the specific strategies that can save you enormous amounts of money over your investing lifetime. I'm going to start with what I consider the most powerful and most underutilized tool in individual investors' arsenal: asset location. Asset location is not the same as asset allocation. Asset allocation is how you divide your money among stocks, bonds, and other asset classes. Asset location is deciding which specific investments you hold in which specific accounts. And this distinction, which most investors don't even think about, can be worth tens of thousands of dollars over time. Here's why it matters. The United States tax code treats different types of investment income very differently. Ordinary income, like interest from bonds or short-term capital gains, is taxed at your marginal income tax rate, which could be as high as 37% at the federal level, plus state taxes. Long-term capital gains and qualified dividends are taxed at preferential rates, 0%, 15%, or 20% depending on your income level. And income inside tax-deferred accounts like traditional IRAs and 401ks isn't taxed at all until you withdraw it, at which point it's taxed as ordinary income. Income inside Roth accounts grows tax-free and comes out tax-free if you follow the rules. These aren't small differences. These are massive differences. And if you understand them, you can structure your portfolio to minimize the tax drag significantly. Let me give you a concrete example. Suppose you have $500,000 in total investment assets. You have $200,000 in a taxable brokerage account, $200,000 in a traditional IRA, and $100,000 in a Roth IRA. And your target asset allocation is 60% stocks, 40% bonds. The naive approach, the approach most investors take, is to hold the same allocation in each account. So your taxable account would be 60/40ths, your IRA would be 60/40ths, your Roth would be 60/40ths. Simple, easy, and massively tax inefficient. Why? Because bonds generate interest income, which is taxed at ordinary income rates if held in a taxable account. That's the highest rate. You're paying top dollar in taxes for income that could be sheltered. Meanwhile, stocks held in a taxable account benefit from favorable capital gains treatment and the ability to defer taxes by not selling. And you're wasting that tax advantage by also holding stocks in tax-deferred accounts where everything gets taxed as ordinary income eventually anyway. The tax-smart approach is completely different. You would hold your bonds, your rights, and other tax-inefficient assets in your IRA, where that ordinary income isn't taxed currently. You would hold your stocks in your taxable account, where you can benefit from capital gains treatment and tax loss harvesting opportunities. And you would hold your highest growth potential stocks in your Roth, where they can compound tax-free forever. Let's run the numbers. With the naive approach, holding bonds in taxable, you're losing maybe 2% annually to taxes on that bond income. Over 30 years on $200,000 of bonds, that's an enormous wealth destruction. With the tax-smart approach, you eliminate that tax drag entirely by holding the bonds in the IRA instead. Studies have shown that proper asset location can add 20 to 75 basis points of annual return. That doesn't sound like much, but over 30 years, 50 basis points annually on a $500,000 portfolio is about $175,000 of additional wealth, just from being smart about which assets go in which accounts. Now, I know what some of you are thinking. Larry, this sounds complicated. I have to track multiple accounts, maintain the same overall allocation but different allocations within each account, rebalance across accounts. That's a lot of work. And yes, it requires a bit more attention than the simple approach. But it's not that hard. You check your allocation across all accounts quarterly or annually. You rebalance by directing new contributions or by moving money between accounts when necessary. And the payoff is enormous. At BlackRock, when we work with high net worth individuals, asset location is one of the first things we address. It's low-hanging fruit. It's money sitting on the table waiting to be picked up. And yet most investors, even wealthy, sophisticated ones, aren't doing it optimally. Let me give you a framework for thinking about this. Assets fall into a tax efficiency spectrum. At one end, you have highly tax-efficient assets, broad market stock index funds with low turnover, individual stocks you plan to hold long-term, municipal bonds if you're in a high tax bracket. These are fine in taxable accounts because they generate minimal current taxation. In the middle, you have moderately tax-inefficient assets, actively managed stock funds with higher turnover, dividend-focused equity funds, balanced funds. These generate more current taxation but still benefit somewhat from capital gains treatment. At the other end, you have highly tax-inefficient assets, bonds, rights, commodities, actively managed funds with very high turnover, some alternative investments. These generate ordinary income or short-term gains that are taxed at the highest rates. The strategy is simple. Hold tax-efficient assets in taxable accounts. Hold tax-inefficient assets in tax-deferred accounts. Hold your highest expected growth assets in Roth accounts. And if you're charitable, hold appreciated assets in taxable accounts so you can donate them and avoid capital gains taxes entirely while getting a deduction for the fair market value. Now let's talk about the second major strategy, tax loss harvesting. This is a technique that can add 50 to 100 basis points of annual value. And most individual investors either don't do it at all or do it poorly. Here's how it works. Throughout the year, some of your investments will be up and some will be down. Tax loss harvesting means selling positions that are down to realize a loss for tax purposes, then immediately buying a similar but not identical investment to maintain your market exposure. You're not trying to time the market or change your asset allocation. You're just capturing tax losses that can offset gains or, if you have more losses than gains, offset up to $3,000 of ordinary income with the remainder carrying forward to future years. Let me give you an example. Suppose in March, the market pulls back and your total stock market index fund is down $10,000 from your purchase price. You sell it, realizing a $10,000 loss. Immediately, you buy an S&P 500 index fund, which is similar but not identical, so you don't violate the wash sale rule. You've captured a $10,000 tax loss, which could save you $2,000 to $3,700 in taxes depending on your bracket. And you've maintained essentially the same market exposure because the S&P 500 and total stock market indexes are highly correlated. Then later in the year, maybe you're rebalancing and you need to sell some stocks that have gains. But you already have losses from your tax loss harvesting. The gains and losses offset, so you pay zero capital gains tax. You've essentially rebalanced for free from a tax perspective. Over a lifetime of investing, systematic tax loss harvesting can add hundreds of thousands of dollars to your wealth. And it's not particularly complicated. You monitor your taxable account, you look for losses, you harvest them when they appear, you buy something similar to maintain exposure, you keep track of your harvested losses to offset future gains. At BlackRock, we've built technology to automate this process for our clients. Our systems are constantly monitoring portfolios, identifying harvesting opportunities, executing trades, tracking losses. And the value creation is substantial. But you don't need sophisticated technology to do this. You just need to understand the principle and check your accounts a few times a year for opportunities. Now, here's where most people get this wrong. They harvest losses in down markets, which is good. But then in up markets, they don't harvest anything. They just let their positions appreciate, building up larger and larger unrealized gains. And when they eventually need to sell, whether for rebalancing or for spending, they face massive tax bills. The smarter approach is to harvest gains as well, strategically. If you're in a low-income year, maybe you've retired or taken a sabbatical or had a business loss, you're in the 0% capital gains bracket up to a certain income level. That's the time to realize gains. Sell appreciated positions, pay zero tax, buy them right back. You've reset your cost basis higher, which means less capital gains tax in the future. Or suppose you're 65 and planning to retire at 70. You have 5 years where you're still earning a high income and in a high bracket. That's not the time to realize gains. But you can still harvest losses to bank them for the future. Then after you retire and your income drops, you start realizing gains at lower rates, offset by the losses you harvested earlier. That's strategic, multi-year tax planning. This is what I mean by tax-aware investing. You're not just reacting to what's in front of you. You're thinking several years ahead. You're coordinating your investment decisions with your overall tax situation. You're being intentional and systematic rather than random and reactive. Let me talk about another critical area where investors waste money. Rebalancing. Rebalancing is important for risk management. When stocks run up and become too large a percentage of your portfolio, you need to trim them back to your target. When stocks fall and you're underweight, you need to buy more. But the way most people rebalance is tax disastrous. They look at their portfolio, see that stocks are now 70% instead of their target 60%, and they sell 10% of stocks and buy bonds. In their taxable account, triggering capital gains, paying taxes unnecessarily, when there were much more tax-efficient ways to accomplish the same rebalancing. Here's how you should think about rebalancing. First, use new contributions. If you're adding money to your portfolio, direct it to whatever is underweight. That rebalances without any selling, without any taxes. Second, rebalance in tax-advantaged accounts. You can buy and sell in your IRA or 401k all you want without tax consequences. Save your tax-free rebalancing capacity for those accounts. Third, if you must rebalance in taxable accounts, do it strategically. Look for positions where you have losses that can be harvested. Sell those. Or look for positions where you have very small gains that won't create much tax liability. Or wait until you're in a low-income year to realize gains. Or donate appreciated assets to charity and buy what you're underweight with cash. At BlackRock, we model the tax impact of different rebalancing approaches for our clients. And the difference between naive rebalancing and tax-smart rebalancing can be 20 to 40 basis points annually. That's real money. That's thousands of dollars a year. And over decades, it's tens or hundreds of thousands of total wealth. Fourth, think about rebalancing frequency. If you're rebalancing monthly, you're probably overtrading and generating unnecessary taxes. Annual or semi-annual rebalancing is generally sufficient for risk management purposes and minimizes tax drag. Now let's talk about something most investors don't even think about until they're in retirement: withdrawal strategy. The order in which you tap different accounts in retirement can have an enormous impact on your lifetime tax bill and on how long your money lasts. The conventional wisdom is you should withdraw from taxable accounts first, then tax-deferred accounts, then Roth accounts. The logic is you want your tax-advantaged money to compound as long as possible. And for many people, that's not wrong. But it's not always optimal. Sometimes it makes sense to do Roth conversions in early retirement when your income is low. You withdraw from taxable and tax-deferred accounts, paying relatively low taxes, and convert some traditional IRA money to Roth. This creates a tax bill now, but it reduces your required minimum distributions later, potentially keeping you in lower brackets throughout retirement and leaving tax-free money for heirs. Or sometimes it makes sense to withdraw proportionally from all account types to smooth your tax burden rather than creating huge tax spikes by exhausting tax-deferred accounts all at once when RMDs kick in. The point is, withdrawal strategy needs to be customized to your situation. How much do you have in each account type? What are your spending needs? What's your state tax situation? Do you expect to leave a bequest? Are you charitably inclined? All of these factors influence the optimal strategy. At BlackRock, we run sophisticated models for our clients to determine optimal withdrawal sequencing. We look at lifetime tax bills under different scenarios. We model different assumptions about returns and longevity. And we develop customized withdrawal strategies that can save $50,000, $100,000, sometimes much more in lifetime taxes compared to the default approach. But you don't need BlackRock to do this for you. You can think through it yourself or work with a qualified financial planner. The key is recognizing that it matters. That the order in which you tap accounts isn't arbitrary. That thoughtful planning can preserve significant wealth. Let me address one more major area of tax inefficiency: fund selection. Even within the same asset class, different funds have vastly different tax characteristics. And most investors don't pay attention to this at all. Index funds, particularly broad market index funds, are generally very tax efficient. They have low turnover because they only trade when the index composition changes or to handle inflows and outflows. Low turnover means few realized gains, means minimal current taxation. Actively managed funds, particularly aggressive ones trying to beat the market through frequent trading, are tax inefficient. They generate short-term gains taxed at ordinary rates. They distribute capital gains to shareholders even if you haven't sold. You're paying taxes on the manager's trading decisions, over which you have no control. ETFs are generally more tax efficient than mutual funds due to their structure, which allows them to avoid realizing gains when investors redeem shares. This is a technical tax advantage that can save meaningful money over time. Dividend-focused funds need to be in the right accounts. If you're holding a high dividend stock fund in a taxable account, you're paying taxes on those dividends every year. That same fund in an IRA doesn't generate current taxation. The point is, tax efficiency needs to be part of your fund selection criteria, along with costs, performance, and other factors. And this is another area where a little bit of attention can save substantial money. At BlackRock, we publish tax cost ratios for our funds, which estimate the percentage of returns lost to taxes annually. Some funds have tax cost ratios of 0.1% or less. Others are over 2%. That difference compounds enormously over time. Now, I want to anticipate an objection. Some of you are thinking, Larry, this is all well and good, but I don't have that much money. I'm just trying to build wealth. Does this really matter for someone starting out? And my answer is yes, absolutely, it matters even more. Because when you're starting out, you have the longest time horizon. Small improvements in after-tax returns compound into the largest absolute differences in wealth. The tax-efficient habits you build in your 20s and 30s will serve you for 50 or 60 years. The tax-inefficient habits will cost you for just as long. If you're young and you're just funding a Roth IRA with $7,000 a year, you're already being tax smart. That money is going to grow tax-free for decades. But you should also be thinking about asset location once you start accumulating money in multiple account types. You should be thinking about tax loss harvesting in any taxable accounts you have. You should be thinking about fund selection. These habits don't require wealth to implement. They just require knowledge and attention. And the earlier you develop them, the more valuable they become. At BlackRock, when we talk to young investors, we emphasize this constantly. Tax efficiency isn't just for the wealthy. It's for anyone who wants to maximize the wealth they're building. And starting early, even with small amounts, establishes the mindset and the practices that will serve you throughout your life. Let me also address taxes in the context of different life stages, because the optimal strategies evolve as your situation changes. In your working years, especially early on, you're likely in higher tax brackets. That makes tax-deferred contributions to 401ks and traditional IRAs very valuable. You get an immediate deduction at your high marginal rate. Roth contributions make more sense if you expect to be in higher brackets later, which might be true if you're early in a high-earning career. As you approach retirement, you might want to start Roth conversions if you have a few years where income dips before Social Security and RMDs kick in. You're creating a tax bill now at lower rates to avoid larger tax bills later. In early retirement, before age 73 when RMDs begin, you have maximum flexibility. This is often the best time for Roth conversions. You can control your taxable income by choosing how much to withdraw and from which accounts. You can fill up lower tax brackets with conversions. After RMDs begin, you're forced to take withdrawals from tax-deferred accounts whether you need the money or not. This can push you into higher brackets. But you can still employ strategies like qualified charitable distributions, which satisfy your RMD but don't count as taxable income if the money goes directly to charity. The point is, tax-smart investing is dynamic. It's not set it and forget it. It requires periodic attention and adjustment as your life circumstances change. But it doesn't require constant attention. Once a year, maybe twice, you review your situation, you make adjustments, and you let the strategy work. That's the difference between tax-aware investing and tax obsession. You're not trying to avoid every dollar of taxes. You're not letting tax considerations drive inappropriate investment decisions. You're just being systematic about minimizing unnecessary taxes within the context of sound investment management. This is how institutions think. This is how family offices for the ultra-wealthy operate. And there's no reason individual investors can't think the same way. The strategies are available. The knowledge is accessible. You just need to pay attention. All right, let me bring all of this together and talk about how you actually implement tax-efficient investing in your life, starting today. We've covered a lot of ground. We've talked about asset location and why holding the right investments in the right accounts can add $175,000 or more to your wealth over time. We've discussed tax loss harvesting and how systematically capturing losses can save you tens of thousands in taxes. We've examined rebalancing strategies that minimize tax drag. We've explored withdrawal sequencing in retirement and how the order matters enormously. We've looked at fund selection and life stage optimization. 6 major strategies, all proven, all accessible, all capable of dramatically improving your after-tax returns. Now I want to help you synthesize this into a coherent action plan. Because understanding these concepts intellectually is one thing. Actually implementing them consistently over decades is another. And implementation is what matters. Knowledge without action is worthless. Let's start with a framework for thinking about your overall tax situation as an investor. I want you to visualize 3 buckets. The first bucket is what I call your tax-deferred space. This is your traditional 401k, your traditional IRA, your SEP IRA if you're self-employed. Money goes in tax-deductible, grows tax-deferred, comes out taxed as ordinary income. This is valuable space, especially if you're in a high bracket now and expect to be in a lower bracket in retirement. The second bucket is your tax-free space. This is your Roth 401k, your Roth IRA, potentially your health savings account if you use it for retirement rather than current medical expenses. Money goes in after tax, grows tax-free, comes out tax-free. This is incredibly valuable space, especially if you're young or if you're in a moderate bracket now but expect higher income later. The third bucket is your taxable space. This is your regular brokerage account, your individual stocks, your non-retirement investment accounts. No special tax treatment going in or coming out, but you have maximum flexibility and you can employ strategies like tax loss harvesting and donating appreciated assets. Most investors focus almost exclusively on the first bucket because that's what their employer offers and what gets the most attention. But the optimal strategy almost always involves using all 3 buckets strategically. And the allocation between buckets matters as much as the allocation within buckets. Here's how I'd think about it. Early in your career, max out tax-deferred contributions to get the immediate deduction and any employer match. That's free money and immediate tax savings. But also fund a Roth IRA if you're eligible. That $7,000 a year growing tax-free for 40 years becomes an enormous asset in retirement. As your income grows and you max out retirement accounts, start building taxable accounts. Don't just pile everything into your 401k even if the limit allows it. Yes, the tax deferral is valuable, but having money in taxable accounts gives you flexibility. You can access it before 59.5 without penalties. You can employ tax loss harvesting. You can donate appreciated assets. You can do Roth conversions in low-income years. The ideal situation is you get to retirement with significant balances in all 3 buckets. This gives you maximum tax optimization flexibility. You can withdraw from whichever bucket makes sense given your tax situation in any particular year. You can do Roth conversions to fill up lower brackets. You can take required minimum distributions but offset them with charitable contributions. You have options. At BlackRock, when we work with clients on retirement planning, we model optimal bucket allocation. For most people, having roughly 1/3 to 1/2 of retirement assets in tax-free space, 1/3 to 1/2 in tax-deferred space, and the remainder in taxable space provides maximum flexibility. But the exact allocation depends on your specific situation. Now, let's talk about implementation. How do you actually put these strategies into practice? Start with asset location. This is the easiest high-value change you can make. Today, right now, look at your portfolio across all accounts. Identify your tax-inefficient assets, bonds, rights, high-turnover funds, commodities. Move those into tax-deferred accounts. Identify your tax-efficient assets, broad market stock index funds, individual stocks you're holding long-term. Move those into taxable accounts. Put your highest expected growth positions in Roth accounts. You don't need to do this all at once. You might need to wait for the right time to avoid triggering large capital gains. But create a plan and work toward it. Within a year or two, you should have your asset location optimized. And once it's set up, maintaining it is straightforward. Second, implement systematic tax loss harvesting. Set a calendar reminder to review your taxable accounts quarterly. Look for positions that are down more than, say, $1,000 from your cost basis. Harvest those losses. Buy a similar but not identical investment to maintain exposure. Keep a running tally of your harvested losses so you know what you have available to offset gains or ordinary income. You don't need fancy software for this. A simple spreadsheet works fine. Or many brokerages now offer tax loss harvesting tools that can alert you to opportunities. Take advantage of them. Third, be strategic about rebalancing. Commit to rebalancing at a set frequency, annually or semi-annually. When it's time to rebalance, first use new contributions to buy what's underweight. Second, rebalance in tax-advantaged accounts. Third, if you must sell in taxable accounts, look for loss harvesting opportunities or positions with minimal gains. Fourth, consider donating appreciated positions to charity and using cash to buy what you're underweight. Make this your default process. Write it down. Follow it systematically. This alone can save you thousands of dollars annually in unnecessary capital gains taxes. Fourth, choose tax-efficient funds. When you're selecting investments, look at tax cost ratios if they're available. Prefer index funds over active funds, all else equal. Prefer ETFs over mutual funds for taxable accounts. Understand what you're holding and how tax-efficient it is. And place assets accordingly. Fifth, as you approach retirement, develop a withdrawal strategy. Work with a financial planner or tax professional to model different scenarios. Understand when to start Social Security. Understand how much to convert to Roth in those early retirement years before RMDs. Understand which accounts to tap in which order given your specific tax situation. This doesn't need to be complicated, but it does need to be thoughtful. A few hours of planning can save you $50,000 or $100,000 or more over your retirement. Sixth, review and adjust annually. Tax laws change. Your situation changes. Markets change. Set aside time once a year, maybe when you're doing your taxes, to review your overall tax situation and your investment strategy. Are you optimizing your contributions? Is your asset location still appropriate? Have you been harvesting losses? Do you need to adjust your withholding or estimated payments? Are there any tax law changes that affect your strategy? This annual review, maybe 2 or 3 hours, keeps you on track and prevents tax inefficiency from creeping back into your portfolio. Now, let me address something important. You might be thinking, Larry, this is great, but I don't have time for all this. I'm busy. I just want to set my portfolio and forget it. And I understand, not everyone wants to be actively engaged with their investments. If that's you, there are a few options. 1. You can use a tax-efficient target date fund that does much of this for you. Many fund companies now offer versions that optimize asset location and employ tax loss harvesting. They're not perfect, but they're much better than ignoring taxes entirely. 2. You can work with a financial advisor who specializes in tax-efficient investing. Make sure they're a fiduciary, make sure they understand these strategies, make sure their fee is reasonable. A good advisor focused on tax efficiency can easily pay for themselves through the tax savings they generate. 3. You can use robo-advisors that offer tax loss harvesting and asset location optimization. Companies like Wealthfront and Betterment pioneered this. Now many major brokerages offer similar services. The fees are low, typically 0.25% to 0.50%, and the tax savings often exceed the fee. The point is, you have options. You don't need to do everything manually if you don't want to. But you do need to do something. Ignoring taxes is not an acceptable strategy. It's too expensive. At BlackRock, we're constantly innovating in this space. We're building tools and products that make tax efficiency more accessible to more investors. Because we believe this shouldn't be a luxury available only to the wealthy with teams of advisors. This should be standard practice for anyone investing for the long term. Now let me talk about some common mistakes I see that undermine tax efficiency, even among investors who think they're being tax smart. Mistake 1. Letting taxes drive investment decisions inappropriately. Yes, taxes matter, but investment quality matters more. Don't hold a bad investment just to avoid realizing a gain. Don't refuse to rebalance when you're significantly out of alignment just because it would trigger taxes. Don't make portfolio decisions purely for tax reasons. The tail shouldn't wag the dog. Mistake 2. Neglecting state taxes. We've been focusing mostly on federal taxes, but if you live in a high-tax state like California or New York, state taxes are a massive additional burden. Strategies like municipal bonds become more attractive. Moving to a low-tax or no-tax state in retirement can save enormous amounts. Don't ignore the state tax dimension. Mistake 3. Forgetting about net investment income tax. If your income is above certain thresholds, $200,000 for single filers, $250,000 for married couples, you pay an additional 3.8% tax on investment income. This can push your effective marginal rate on investment income very high. Understanding where you are relative to these thresholds and managing your income accordingly matters. Mistake 4. Not coordinating with your tax preparer. Your investment strategy and your overall tax strategy need to work together. If your tax preparer doesn't know about your investment moves, they can't help you optimize. And if you're making investment decisions without understanding your full tax picture, you might be working at cross purposes. Coordinate, communicate, make sure everyone's on the same page. Mistake 5. Giving up in the face of complexity. Yes, taxes are complicated. Yes, the rules change. Yes, there are nuances and special situations. But that's not a reason to ignore the issue. You don't need to become a tax expert. You just need to understand the basic principles and either implement them yourself or work with someone who can. At BlackRock, we deal with some of the most complex tax situations in the world. Institutional investors with operations across dozens of countries, alternative investment structures, derivatives, everything you can imagine. And yes, those situations are incredibly complex. But for most individual investors, the tax strategies we've discussed today cover 90% of the opportunity. They're not that hard. They just require attention and discipline. Let me also address the question of how much of your time and energy tax efficiency should consume. Because there's a balance here. You don't want to be so obsessed with taxes that you're spending hours every week on this. That's not a good use of your time. But you also can't ignore taxes and hope everything works out. My recommendation: spend significant time up front getting things set up correctly. Read about these strategies, understand them, implement them in your portfolio. Maybe that's 10 or 20 hours initially. Then spend a few hours quarterly reviewing for tax loss harvesting opportunities and checking your asset location. And spend a few hours annually doing a comprehensive review and planning for the year ahead. That's maybe 30 to 40 hours a year. Less than an hour a week on average. And the return on that time investment is enormous. If it saves you $5,000 or $10,000 a year in taxes, that's a phenomenal hourly rate. Better than almost anything else you could do with that time. And as you get more experienced, as these practices become habitual, the time requirement decreases. It becomes second nature. You make tax-efficient decisions automatically without having to think about them consciously. This is exactly what happens with institutional investors. Tax efficiency isn't a separate project for them. It's built into their investment process. It's automatic. And that's where you want to get to as well. Now, let me paint a picture of what your financial life could look like if you implement these strategies consistently over decades. You're 30 years old. You start maxing out your 401k. Getting that employer match, getting that immediate tax deduction. You also fund a Roth IRA every year. And you start building a taxable account, investing in tax-efficient index funds. You implement proper asset location. You harvest losses quarterly. You rebalance intelligently. Over the next 35 years, you contribute diligently. The markets do what markets do, up and down, but generally trending upward. Your portfolio grows. And because you're tax efficient, you're keeping more of that growth. You're not giving the IRS 150 to 250 basis points every year. You're keeping it, and it compounds. At age 65, you retire. You have $2 million across your various accounts. But here's the thing. If you hadn't been tax efficient, if you'd been average, you'd probably have $1.5 million. The difference, that extra $500,000, that came from tax efficiency, from the losses you harvested, from the optimal asset location, from the smart rebalancing, from the fund selection, from all the little decisions that individually don't seem like much but collectively are transformational. And now in retirement, you continue being tax smart. You do Roth conversions to fill up the 12% bracket. You defer Social Security to maximize your benefit. You tap accounts strategically. You use qualified charitable distributions. And because of all this, your money lasts longer. You pay less in taxes every year. You have more to spend. You have more to leave to your kids or to charity. You've won the game. That's the difference tax efficiency makes. Not in theory, in practice, in real dollars, in real financial security, in real quality of life. Compare that to the alternative. Same contributions, same time horizon, same gross returns. But no attention to taxes. No asset location optimization. No tax loss harvesting. Random rebalancing triggering unnecessary gains. Tax inefficient funds. Suboptimal withdrawal strategy. You end up with $1.5 million instead of $2 million. You run out of money at 82 instead of having surplus at 90. You can't help your kids as much. You can't give to causes you care about. You're stressed about money in what should be your golden years. Same starting point, same effort in terms of saving, but massively different outcomes, because one person understood taxes and the other didn't. I don't want that to be you. I don't want you to look back at 65 or 70 or 75 and realize you left hundreds of thousands of dollars on the table. I don't want you to be the investor who was smart about everything except taxes and lost because of that one blind spot. So here's my challenge to you. Decide right now that you're going to take tax efficiency seriously. Not obsessively, not to the exclusion of good investment management, but seriously, as a core part of your wealth building strategy. Start this week. Look at your portfolio. Understand what you're holding in which accounts. Identify the most egregious tax inefficiencies. Make a plan to fix them. Set up a system for tax loss harvesting. Choose a date for annual review. Write down your strategy. If you don't feel confident doing this yourself, hire help. Find a fee-only financial planner who specializes in tax-efficient investing. Or use a robo-advisor with tax optimization features. Or take an online course to build your knowledge. Invest in your education. The return will be enormous. But don't do nothing. Don't continue sleepwalking through your investment life giving the IRS tens of thousands of dollars more than you legally owe. That's not noble. That's not patriotic. That's just wasteful. And you owe it to yourself and your family to do better. At BlackRock, we've spent decades helping clients optimize their after-tax returns. We've built technology. We've developed processes. We've trained teams. We've invested billions of dollars in tax-smart infrastructure. Why? Because we understand that after-tax returns are all that matters. Because we take our fiduciary duties seriously. Because we want our clients to build maximum wealth within the bounds of the law. You should want the same thing for yourself. You should demand the same level of tax awareness from yourself or your advisors that institutions demand. You should refuse to accept tax inefficiency as inevitable. The strategies we've discussed today, asset location, tax loss harvesting, smart rebalancing, optimal withdrawal sequencing, efficient fund selection, life stage optimization, these aren't secrets. They're not complicated. They're not available only to the wealthy. They're available to anyone willing to pay attention and be systematic. And the opportunity cost of not implementing them is staggering. We're not talking about a few $100s. We're talking about hundreds of thousands of dollars over a lifetime. We're talking about the difference between financial security and financial stress. We're talking about the difference between leaving a legacy and running out of money. This is too important to ignore. This is too valuable to postpone. This is too impactful to delegate to someone who doesn't understand it. You've invested time in watching this video, in learning these concepts. Now invest the time to implement them. Make tax efficiency part of your investment DNA. Make it automatic. Make it systematic. Make it non-negotiable. Because here's what I know after almost 50 years in this business. The investors who build lasting wealth, the ones who retire comfortably, the ones who achieve financial independence, they're not necessarily the smartest or the luckiest. They're the most systematic. They're the ones who get all the details right. They're the ones who understand that investing is a long-term game where small advantages compound into enormous outcomes. Tax efficiency is one of those small advantages. It's not sexy. It's not exciting. It's not going to make you rich overnight. But consistently applied over decades, it's going to add hundreds of thousands of dollars to your wealth. It's going to give you security and options and peace of mind. And that's worth far more than any hot stock tip or market timing strategy or get-rich-quick scheme. So implement these strategies. Start today. Monitor your progress. Stay disciplined. Adjust as circumstances change. And watch your after-tax wealth grow faster than you ever thought possible. The tax code is the rulebook. Most investors don't bother to learn it, so they keep making unforced errors. You're going to learn it. You're going to play by the rules but optimize within them. You're going to keep every dollar you're legally entitled to keep. That's how you build wealth. That's how you win the long game. That's how you ensure that 30 years from now, when you look back on your investing career, you can say with confidence, I did this right. I maximized my after-tax returns. I built the wealth I needed. I didn't leave money on the table. Make that commitment now. Your future self, the one living comfortably in retirement with financial security and peace of mind, will thank you for it. Tax efficiency. It's not optional. It's not advanced. It's fundamental. And now you know how to implement it. Go do it.